All right, let's stay on all things economy and the consumer. Strikingly different tone from shipping giant UPS this morning on its earnings report compared to longtime rival FedEx. UPS showing good growth in the U.S. and reaffirming its full-year guidance ranges. This comes hot on the heels of FedEx badly whiffing on earnings and uncorking a fresh restructuring plan just a few weeks ago. UPS CFO Brian Newman just got off his earnings call and joins us now. Good to see you here, Brian, as always. Just for the lay investor out there, these stories between a UPS and a FedEx are now strikingly different, like I just mentioned. Why do you think you and your team are out executing a FedEx?
Hey, Brian, good morning. It's great to see you. Listen, we have a mantra around here, which is control what you can control. And we've been really focused on doing that over the last couple of quarters. The macros have been challenging domestically and particularly internationally. But we've been focused on, with softer volumes across the world, really, how do we ensure we drive the right pricing mix and dynamics and also control the cost? By doing that, you protect your margins and deliver to the shareholders.
And Brian, I just want to stay on that before we jump onto the broader quarter. So you're not out there closing sorting facilities, laying people off, right? I just want to make sure I have it right.
So we are tightening the belt, certainly at the corporate. We spend a lot of money in G&A. We've been tightening the belt there, but we've been doing that for a couple of years, trying to right-size the business. Carol introduced a better, not bigger strategy to the company. And what that really is, optimize the volume that comes into the system so it's more profitable and then take the cost down. So we have been certainly right-sizing the business over the last couple of years, but no, we're not closing sorting facilities right now. We have the ability to take our variable to semi-variable costs down should the case arise.
And so where are you seeing continued strength within the business and the customers that you're servicing right now?
That's a great question, Brad. The healthcare segment is a particularly strong one. We're doing very, very well there. As you think about the small and medium business, that's been a core focus over the last couple of years. We've been addressing the capabilities that those customers want. And by doing that, you create a wonderful environment for a very profitable customer. So we've been focused on the SMB, small and medium business, the healthcare segment, and then overall, trying to look at that international business because there's lots of growth opportunity there for us.
We've been talking a lot about FX headwinds that companies are seeing right now. And when you think about that international business, of course, UPS is going to be rolling out some pricing increases. This also impacts the international segment in December, I believe, and that really going to be reflected as you finally get into 2023 as well. What is your anticipation around where the consumers and the strength that you were just laying out, where they'll continue to take that price increase?
So we announced a price increase for next year at 6.9%. That's supposed to be representative of a combination of inflation as well as the service we provide. So that'll help drive the base rate in terms of the pricing equation. As we think about the currency impact that you mentioned, Brad, the currency impact in the quarter was about $82 million. So it is a meaningful headwind on our international business, but we're effectively offsetting that as we manage the portfolio across the domestic business and then across some of the other segments.
Brian, I recently spoke to another Brian, Brian Cornell over at Target for our All Market Summit conference last week. He said the holiday season he's expecting to be pretty good. What's your read on things?
So Brian and I used to work together at PepsiCo, so I know him, and Target is a very important customer for UPS. I actually think it's going to be a decent peak season. We're ramping up right now. We're hiring. We hire over 100,000 people for the peak season to get ready. And with customers like Target, we're out there committing to them that we're going to be there with the excellent service that UPS provides. So I think that, Brian, the peak season, our peak season volume goes up 50, 60% from a normal run rate. So it is a meaningful increase. But as we think about peak this year, you don't have the low inventory levels that we saw last year, which drove an earlier peak. People were rushing out to buy because they were afraid the inventory wouldn't be there for the holiday season. This year, inventories are much higher at the retail stores. So I think it'll be a bit of a later peak, Brian.
All right, competing against Santa Claus-like efficiency there in the logistics business. When you think about some of the future investments as well there, Brian, and going out into next year and even beyond, what are the investments that you would like to see the company get right the first time in order to build a logistical network and a system that can really see its margins excel over the future?
So it's a great question, Brad. The digital investments we're making, it's really shifting dynamic of UPS, old school package delivery to now it's more of an orchestrator of volume from end to end. We're putting investments into things like RFID technology so that every package in our system will have a code on it that we know where it is. And if there's nothing more frustrating for consumers or customers when they lose a package or they have an issue, they want to know where that package is. By deploying this kind of technology, we're going to be able to tell people where are your packages and how can we recover and make sure we get them there on time for when the customers want them. And we do that at an incredible mid-90s% in terms of on-time delivery.
Brian, I made this comment earlier in the show before you came on, and I said UPS is benefiting from, of course, having you as CFO, but also Carol, too, longtime CFO of Home Depot before she came to you. Am I off base there? Are you guys just looking at the quarter or your business differently than other big public companies?
Brian, it's wonderful to have a boss who used to be a CFO because we have great conversations. But Carol has done an amazing job shifting the culture. So as we think about the future of UPS, yesterday's UPS is not going to get us to tomorrow to where we want to be. We're a 115-year-old company, very proud of our past. But Carol is shifting the company to a place called better and bolder. The bolder is growth and margin improvement. And so where is that going to come from? Areas of basically leaning into the most attractive parts of the market. I mentioned SMB, margins are great. It's a very attractive area. Healthcare, that's a high growth, high margin area. International, we're actually number 2 and 3 in a number of markets overseas. So we're focused on stealing revenue share, value share, as we call it, and going out there. So we're putting our investments in those areas that will be accretive from an investment perspective.
UPS CFO Brian Newman, thanks so much for joining us here this morning and breaking down the most recent quarter. Appreciate it.
Thanks, Brian. Brad, thank you.